It's 4 p.m. here at DBS Asia Central. I'm Taimur Baig, DBS Group Research's Chief Economist. Welcome to our September Macro Insights live stream. Today, it's largely about FX, and hence we have two FX experts with us, which actually makes up the entire FX expertise in Group Research. Senior FX strategist Philip Wee and Chang-Will Young, rates, credit and FX strategist. He also wears a crypto hat, but today I don't think, other than toward the very end of the Q&A, Will Young will have too much time to talk about crypto. We did a crypto webinar 2 weeks ago. I'm sure we'll be doing it more. We put that aside for the time being. So, gentlemen, it's been quite an exciting month. We saw an anomalous thing happen on Singapore's exchange rate. We have seen a lot of political weight on INR, IDR, probably even on JPY. So I'm assuming you guys will cover all of that. But before the FX part really kicks in, I'll spend a little bit of time talking about the global macro backdrop. So, gentlemen, let me take over for the time being, and then we'll bring you again sequentially. Thank you. So the outline of today's presentation is as follows. We will start with the macro backdrop, then FX bifurcation part 1 by Philip Wee, and then Will Young will largely talk about the RMB and JPY. But as I alluded to earlier, there's been a lot of pressure on the INR, on the IDR, around tariff, on politics. So there will be other currencies to talk about as well. And of course, we are doing this in that week in September when the FOMC will meet, and what that means for FX, particularly the DXY, is going to loom over us as well. But before going to all that, let me just remind you, this is a live stream, and we do take questions. On the screen right now is a QR code that will allow you to scan and submit questions through Pigeonhole. If you don't want to use the QR code, just type dbs.pigeonhole.at on your web browser and enter the password MACRO, M-A-C-R-O, and that'll take you to the questions. We would be happy to take as many questions as we can, assuming the three of us manage to get through in the first 50 minutes or so. So on the global macro backdrop, start with a comparative discussion on global macro momentum, and by comparative, I mean the US, Euro area, and of course, China. I will, after this slide, spend most of my time talking about the US. But let's begin with a global flavor of what's happening. And as you can see, the Eurozone, after being in the doldrums in the late first quarter, early second quarter, has sort of picked up, or perked up rather, with some degree of data surprise that actually puts it at the top of this comparative list. US, by the way, after a little soft patch that we again saw in sort of around the June, July area, the last 6 weeks has been very strong and it's picked up. So on one hand, of course, we will talk a little bit about the weakness we're seeing in the labor market and how that will most likely influence the Fed. But overall activity, whether it is industrial production or the services industry or what's happening with retail sales, it doesn't really show signs of an economy that is at recessionary risks. So the labor market is giving us very different kind of signals, and I'll parse through that later. But when we talk about overall flow of economic data, US data economic surprises are actually in pretty strongly positive territory. If I were to show you our usual Atlanta nowcasting chart for the third quarter GDP, that's right now tracking at almost 3%. Not exactly something that should make the Fed really worry about where the US economy is going, but labor market, we'll get there in a minute. China, on the other hand, in contrast to the US and Europe, has had a pretty soft patch the last couple of months or so. We are not really seeing the much expected turnaround in economic momentum, given all the supportive measures that have been pushed through all through 2024 and so far this year. This only means one thing: more supportive measures are in the pipeline as far as China is concerned, supporting the property market, supporting consumption, particularly white goods purchases through some other initiative that the government is prone to be doing, and the Chinese have become increasingly comfortable and sort of, they expect it, that just around the corner there'll be one more incentive to buy cars or buy other white goods. So we are in a sort of odd juxtaposition right now globally. The large economies like Euro area as well as the US are actually showing pretty decent momentum. China, having started the year pretty strong, has sort of lost its way quite a bit. But funnily enough, we don't have many big bang policy measures being expected by the market with respect to China. Whereas in the US, which at least by this chart, doesn't really need a lot of policy support, We've had a big fiscal stimulus measure, and perhaps starting this week, we're going to have a series of monetary stimulus measures as well. All right, let's go and talk about the US labor market, given that that's been on the headlines repeatedly over the past week or so. Unemployment rate, pretty low. 4.2, 4.3 doesn't really make any difference. There are questions about the size of the labor force with all these undocumented workers leaving the US or becoming discouraged from looking for a job, which might create sort of an artificial sense of tightness in the labor market. But the fact of the matter is, in terms of vacancies, in terms of hiring, the picture is not as strong as it was about 6, 9, or 12 months ago. So Donald Trump would not like this. Even if he managed to fire every single person in BLS, I don't think our perception with respect to the US labor market will change. It is one of marginal weakness. But there are some silver lining. Number one, unemployment rate itself is still pretty low, and wage growth, as you can see here, the red line is denoting 3.7%, way ahead of inflation. So from an overall prosperity, purchasing power perspective, Americans are doing pretty okay. Whether a shoe is about to drop is the big question. So one way of thinking about the shoe dropping is looking at the payrolls numbers, which has been notoriously volatile. It's really caused Donald Trump to get very angry. But after the numerous revisions that we have seen, and we got one more wholesale revision earlier this week, what we see now is that there's been a pretty sizable drift down of job creation. We're not in negative territory, not like the way it was during the pandemic or in a typical recessionary environment. We're not in very good territory either. What I'd like to do is actually parse through labor market data, especially the payrolls data, but along different dimensions in the following slides. Take, for example, breaking down payrolls by goods and services sector. And the reason for this is obvious. Mr. Trump is all about the goods sector. He wants good blue-collar jobs, which Americans with little education would do and produce lots of things that Americans have been buying from the Chinese and elsewhere all these years. Well, so far, it's not going very well. The goods sector is actually shedding jobs, not adding jobs. Contrast that with the Trump 1.0 time or Biden, when it really was the golden age in the last 10 years in terms of goods sector hiring. But even within that construct, that it's bad this year, it was good during Biden's time, it was slightly worse than Biden during Trump's time, but this is a particularly bad year. We should also consider that even during the good years, goods sector didn't really make a lot of jobs in the US. US is a largely service sector economy, and you have in service sector the biggest source of job creation. It was exceptionally buoyant during the Biden term. It has lost tremendous amount of momentum in the 8 months of Trump that we've had, and that to me is a bigger source of worry than anything else. Then why isn't the service sector hiring, given that it is unaffected by tariff-related issues, it is helped by low cost of production as far as energy and food is concerned? Why are we seeing this problem in the services sector? Is it because of AI? Is that the main reason? Could be. Don't have a very strong answer to that. We could argue that some sectors in the US, maybe because of the whole AI trend, is shying away from job creation, but that cannot be the whole economy. Maybe there's more to that story. Let's look at this next slide to get a better sense of that. Okay, same again. We're looking at payrolls data, but we're breaking it down this time around different axes, public sector and private sector. You can't see the public sector box anymore in the 2025 bar. It is so small, it's basically 1,000 on average over the last 7, 8 months. And that certainly hurts, because if you look at the Biden years, public sector was a very decent source of employment, averaging about almost 40,000 jobs a month. That has basically gone to zero. Surprise, surprise, DOGE happened. States have tried to offset some of those firing with state-level hiring, but overall, net impact is, Elon Musk wins. A lot of people in the U.S. public sector have lost their jobs, and the states haven't actually offset that job loss in any meaningful manner. They've hired a little bit, but essentially, public sector employment is down to zero. But private sector, again, going back to the whole Gen AI question, only 73,000 so far this year on average, compared to the 300,000 during the Biden years. I don't think it's all about AI. AI is not something that started in 2025. It's been around for a few years. And in fact, beyond Gen AI, I think the source of automation around artificial intelligence, not large language models, has been a trend for the last 15 years. I don't think we should attribute this slowdown to just ChatGPT and Gemini. I think there's much more to that. Uncertainty related, the trade war, immigration related measures that the Trump administration has taken, defunding public sector, defunding education sector, all those things play into a role, and tech disruption arguably has a role into playing it, but it's not the only thing. So let's not attribute everything that's happening to the US to ChatGPT. Inflation side, very mixed picture. Those of you who attend our live stream regularly know that in the aftermath of the reciprocal tariff announcement in April, we featured several charts from University of Michigan which showed exceptionally heightened amount of uncertainty with respect to the economic outlook as well as inflation. We will share that chart momentarily. But the fact of the matter is that impression notwithstanding, we haven't seen a major upward spike in inflation so far. So far as the operating word, we might most likely see a gradual, a protracted pass-through from tariff to consumer prices over a 6 to 12 month horizon. Nobody wants to raise prices by 10% and catch Trump's ire, and hence they will do it stealthily, slowly, initially squeezing their suppliers, then taking some on their balance sheet, and finally passing it on to the customers. It will happen. It will happen gradually. Our forecast of 2.75% inflation for 2026 might be subject to upward risk because some of the inflation risk that was supposed to manifest in 2025 will probably spill over to 26, assuming the tariffs stay where they are. But short of that, just looking at this chart right now, it's a completely backward-looking chart, saying nothing about the future, but it is telling you that you will be hard-pressed to find any meaningful upward trend in PCE, urban CPI, or core PCE over the last 8-9 months. So far, so good, not much tariff showing up. We break down the CPI. When we do that, we see some evidence of tariff pass-through, washing machine prices, which is a famous gauge, but a few other goods, furniture in particular, prices have gone up. But the interesting thing for me is not what's happening with goods prices, which will, in my view, sooner or later manifest in slightly higher prices at the retail level. What is surprising to me, or striking to me, is that services inflation has begun to pick up. In the last month's data print, we saw financial services prices pick up. We saw healthcare-related costs go up. I think we will see far broader manifestation of higher prices in the services side, not because of tariffs, but because of immigration measures. If you think about the US service sector, agriculture, fisheries, construction, hotel and hospitality, in all of these areas, there's a substantial amount of undocumented worker involvement. The chilling impact on undocumented worker supply will start having an impact on these sectors, and you might see prices go up there because of the tightness in labor supply. But if we again sort of focus on the core measures, so I have on the screen right now the Dallas Fed's trim mean PCE inflation, both at the headline and the core level at the 1 month and 6 month level. And they don't, again, scream out for being worried about inflation going toward 5%. That is not on the cards. But could inflation go toward 3.5%? Well, there's some ways of looking at it through leading indicators which might suggest so. Let's look at one of those. This is a relationship between the money supply and core PCE, and I put the money supply with a 12-month lag. So if today money supply goes up, over the next 12 months, that creates an impulse on the price-generating mechanism that makes up the CPI. Well, that relationship was held pretty well, the lead-lag relationship back in the pandemic days. We saw a big pickup in money supply, and almost by clockwork, we saw a pickup in inflation down the road. Now, money supply was almost in contractionary territory in 2024. The Fed was doing QT, Fed was not really pushing on a string. It was actually raising rates substantially and giving fairly hawkish signals. All of that has changed, especially in recent months. We are all sort of gone away from discussing tightness of monetary policy to how much more easy policy will be going forward, and money supply has also picked up. Relationship between money supply and CPI, if you go with the historical relationship, is pointing toward 4 or 5% inflation. That's a bit worrisome if you're just strictly going with the monetary theory. And then the good old University of Michigan chart looking at consumer sentiments and inflation expectations. Some of the panic in the immediate aftermath of reciprocal tariff has dissipated, but still it is exceptionally high. Consumers are still expecting 5% or so, or 4.5% or so inflation. Their sentiment with respect to the economic outlook is exceptionally poor, almost as poor as it was during the pandemic. So that is a big source of concern. In fact, this chart to me is a stagflation chart. People are worried about jobs, income, overall economic activity, but they're also worried about high inflation. So that to me is a pretty worrisome picture. I have a feeling most people in the Fed are not really paying much attention to these sort of markers. They are looking at the earlier charts that I showed, which is the trim mean core inflation remains stable. They don't see anything on the headline side with respect to risk on energy and food. And on the core side, they will probably look at the services inflation and some goods inflation pass-through as quote unquote transitory. And then there are other surveys, not just the University of Michigan survey that we look at. So this is where we see the PMI prices paid index, both in the manufacturing and non-manufacturing side, very elevated, very elevated. It hasn't corrected the way the University of Michigan survey inflation expectations has. Maybe on the margin, the manufacturing side eased a bit, but still very high. I mean, pandemic day type high. And that is, again, a big source of worry. Then you can extend that sort of analysis to prices paid and prices received type responses through various surveys that is done by various feds with respect to regional manufacturers, and they look really bad, really, really bad in terms of the price pressure that companies are facing and the kind of pressure they want to actually start passing on. So with all this, you would think that the Fed would be careful and would be giving hints about wanting to be very vigilant about inflation. Well, not at all. It's the opposite. Starting with Jackson Hole, Chair Powell, and then various other Fed governors have been pretty vocal that they're ready to cut rates, not just once, but several times going forward. And the market in the last few days has gone super dovish, especially after the bad payrolls number that came out last Friday, and now expecting almost 75 basis points in rate cut just this year. We're not in that camp. We're still going with the 25 basis points each calibrated cuts in 2 meetings in the September onward of this year, 50 basis points. But the market, as you can see, changes his mind quite a bit. In just the course of this year, there was a time the market was pricing in 100 basis points of rate cut, then 50, now 75. We've been fairly lazy with our forecast, even kill 50 basis points, and I think we're on decent grounds for that to happen. For 2026, expectation is for another 75 basis points. So we have now gone to 6 cuts in this monetary policy cycle. It is possible. Everything is possible under the pressure from Donald Trump. But I think given what we just looked at with respect to inflation dynamic, the Fed would really risk its credibility in a very big way, in a historic way, let's put it that way, if it were to go ahead with 6 rate cuts over the next 12 months. It will not look good optically, especially given the pipeline pressure we have from tariff as well as immigration-related tightness. What has that meant for yield curves? Well, pretty anomalous. In the case of the US, there's been a substantial shift downward. Makes sense, but look at the shift downward of the Singapore dollar curve. And this is a bellwether for what's happening around the world, that money has flowed out of the US markets into emerging markets, into developed markets in the non-US jurisdiction. Liquidity is so big in places like Hong Kong and Singapore that short-term rates have crashed. The monetary policy authorities have had to intervene to take some of the liquidity out through open market operations to bring rates up, because at some point it was looking like, Southeast Asia, few places were heading toward Switzerland type dynamic, rates at their floor, massive exchange rate depreciation pressure and so on. Maybe that's what that's the inevitable outcome of the uncertainty that is coming out of the US, but it doesn't make for easy policy making in the non-US jurisdictions, and that's the kind of challenge we'll see play out independent of whether there are 6 cuts or 4 cuts in this cycle. I'm going to talk a little bit about financial markets. I told you earlier that Will Young does cover credit, but today he probably will not have time to cover credit or crypto, focus on FX. So let me just say something that he probably would have said, that we have seen this exceptional rally in emerging market credit, in developed market credit, in high yield, in investment grade, everywhere. The spread compression has been absolutely startling. I would have looked at this chart 3 months ago and I would have said they can't go any lower, and I would have been wrong. They've gone lower even further. But seriously speaking, there is a limit of how much this credit market can rally, and we're going to be very cautious going into the last quarter of 2025 on the credit side. In the equity side, the market keeps on remaining very, very lackadaisical, very complacent. Valuations are exceptionally high. When the US markets open tonight, we will see Oracle prices rise by 25 to 30% because they gave strong revenue guidance for the next 5 years, and the market is completely buying it. VIX volatility spiked a little bit earlier this year. It's come down substantially. So across the board, very, very comfortable sentiments in the markets, which worries me, especially when I consider this, that the yield gap, the US Treasury yield minus S&P 500 dividend yield, is at the same level as it was right before the global financial crisis. That is not a good chart to look at when you're thinking about the investment horizon. So lots of risks percolating on the inflation side, as I had alluded to, and on the financial market side, things there are to worry about. Okay, I'm going to stop now. Philip, if I may bring you back to the stage, and all yours, and tell everybody to use the QR code as well. Thanks, Philip.
Okay, thanks, Timer. Okay, thanks, Timer. If you have any questions, the QR code is there. Okay, I'm going to start out by just sharing what we have just published in our FX Quarterly a couple of weeks ago. I think the first hard question we had to ask is the weak dollar over? After that, I think more than 10% drop in the DXY index in the first half of this year. So that was the worst, I think, first half decline since 1973. Okay, so what I want to show here is that in examining, I think the past precedents is that you need to be still quite vigilant that the dollar is still not out of the woods yet, and that it could continue to drop in the second half, but not as ferociously as what we have seen. And also keep an open mind that once the dollar weakness comes in, it could spill over into the following year, which is what we are also projecting in our forecast. So, but meanwhile, in the short term, ever since Liberation Day came, the dollar index profile, the gradient has sort of flattened and it's become more volatile. What we try to do here is on the right-hand side of the chart, map out a price channel that shows you that it's still heading southwards. But at the same time, we are also having to deal with a lot of non-US factors, like political uncertainties, worries about government bond yields being higher, etc., etc. So, but nonetheless, we remain, I think, quite mindful that in the end, when the US is out to adjust trade imbalances, it is very hard not to include the currency adjustment. So what I think caught my attention a lot is the nomination of Stephen Moran, to replace Adriano Kugler as Fed governor. So Moran, together with Treasury Secretary Scott Bessent, they are both authors of the Mar-a-Lago Accord. So, and we have already seen the implementation of the first phase using tariffs, and and you can see through the trade negotiations how Trump uses market access and with Europe security commitments as negotiation tools to push through the trade agreements. So going forward, we still have the push, which we are seeing coming for U.S. interest rates to head lower, and we do believe that with that they are also targeting devaluation to make U.S. exports more competitive, and not forgetting also that many of the trade deals involve countries buying more U.S. goods as well as investing more in the U.S. So that naturally do imply that they do want currencies to be stronger in many countries. So Trump has said many times that the Japanese yen, the Korean won, they're pretty high. So if you step back, and not just look at, let's say, the 10% drop that we've just seen, and all the way back to the global financial crisis. I think when you compare it with the Plaza Accord on the chart on the right, you can see that the currency adjustment from policy makers is probably much deeper than what we in the markets are thinking about. So our time frame is more short term. Okay, but nonetheless, we do need to be watchful for this risk going forward because of the push, which the market sees as undermining the Fed's independence, and Trump, talking about 1% interest rates, which is below the ECB's 2% rate, and of course, recent comments that the Bank of Japan may be behind the curve in terms of hiking rates. Okay, moving on. So today's topic is about bifurcation. So Timer has thrown a very big challenge. So we've been looking through what sort of focus things should we be focusing about. So I think the first one is probably monetary policy, the divergences. Of course, the biggest, I think, breakaway from the US is the threat to its independence, so which is the overriding, I think, factor for us in keeping the underlying weak dollar view. But nonetheless, let's say into this September Fed cut, we have put up 3 tactical trade ideas, on different divergences. Firstly, the one that we like the most actually is the one that we haven't put on yet, and that's the dollar yen, because of directional differences. So, I mean, we do think that Bank of Japan will hike rates again, but due to the political uncertainties, Wei Liang will talk more about it later. So that has sort of kept it as a pending trade. The other 2 that we are more comfortable with is long sterling. So next week, Bank of England will be meeting 1 day after the Fed. So, and you can see from the table that most of the European central banks seems to be on hold for the rest of this year. As the debate, I think the main focus at the FOMC is whether the Fed is going to deliver 1, or what the market is thinking, 3, 1 cut at the remaining 3 meetings of this year. So then the other divergence trade is the one that we thought, why not focus on neutrality? So naturally we like the euro, but because of the French crisis, we felt that it would be too much volatility to handle. So we decided to go with the British pound. And of course, people will be asking, don't they have a fiscal issue problem? Don't they, isn't it more vulnerable to the 30-year yield? I said, yeah, but we have also seen how Fed cut expectations helps to tame the bond market recently, especially when the US job numbers are on the weaker side. So okay, so in terms of neutrality, RBNZ, yes, the market is looking for 2 cuts, but I'm not so sure whether this is cast in stone. But the other thing is that they have also arrived at neutral, way before the Fed. So we thought that maybe that would be a good trade to put on. Okay, on the tariff, the impact so far hasn't been what I think most people would expect when you translate it into the FX space. Okay, so what I've done here is on the right-hand side, put the difference in the tariff rates that were announced on Liberation Day on April 2nd, and on the executive order that Trump showed everyone on July 31st. So I think just for simplicity, if you look at let's say level to level in terms of tariff, let's say for Japan and for UK, which depreciated the most in this second round of tariff announcement. They have been definitely more volatile in terms of giving back their dollar gains in July. And if you look at, let's say, the box that I mapped out in the center, you don't really see the kind of material impact as well. So most of the currency losses were quite close to each other. We are not looking at double-digit movements. Even for example, the Swiss, went back empty-handed, even though the president visited Trump in the White House. And tariff remained at 39%. But then again, the payback for the Swiss was only about 2 to 3%. So Sing, also gave back about 2% by virtue of its price taker, even though our rate remained unchanged at the universal base rate of 10%. Okay, so moving on. Okay, so let's look at some of the bifurcation terms. So I thought, why not compare safe haven with risk-beta currencies? Okay, there's three safe haven that we talk most about is naturally the Swiss franc for Europe, and the Japanese yen, which has been doing quite well until the political challenges, the upper house elections, and now the LDP leadership uncertainties, which spills over into fiscal worries as well. So what you have seen is that yen has been moving quite nicely with the Swiss as a haven, but it broke in recent months, and its performance has been more or less tagged with the Sing dollar, which is the top haven in the Asia ex-Japan currency space. Okay, so on the right-hand side, the risk appetite currencies tend to be likened to the commodity-led. So and this is where you can see very clearly that when Liberation Day came, Australian dollar was actually hit the hardest, primarily because almost 3/4 of its exports head to Asia, where most of the tariff rates were higher. So, but yes, recovered, but the recovery has been slow and stagnant around the 5% year-to-date level, pretty much same where that we've seen for the other currencies as well. So, but nonetheless, they do move as a group, and as I mentioned before, I've manifested my monetary policy divergence, and I've chosen the Kiwi dollar by virtue of the fact that it does have this tendency to outperform the group whenever risk appetite comes in. So which is why I chose it more than the Australian dollar, which what most people would have done. Okay, for the BRICS currencies, there are 6 in Asia. Quite interesting. They are evenly split. 3 that are strong and 3 that are weak. So so the strong ones are the 2 partner currencies, Thai baht and ringgit, in Southeast Asia. Okay, so if you look through their performance in the past, okay, these 2 currencies have ever since the Fed started fighting inflation in 2022, so they get hit very hard when Fed hikes aggressively. But the moment Fed dials down or turns dovish, they also push very strongly. So in Asia, these are the 2 currencies that I would normally like when we have a Fed, that is moving into into resuming its rate cut trajectory. Okay, renminbi has edged off the 0% year-to-date level, so it has been tracking the fixing, and it's been moving, slightly higher ever since the first trade truce. So this is in the anticipation of the U.S.-China trade deal, and hopefully, we do get something by November, and hopefully, Trump doesn't hit China like the way he hit India to pressure Russia to get a peace deal in Ukraine. Okay, and also another thing is that China has last year into the 50 basis cut in the Fed funds rate last September, also allowed the renminbi to appreciate into that easing. As for the other three BRICS currency, so full BRIC member, the two full BRIC members are rupee and rupiah. So they have, I think for the Indian rupee, the main shock has been, if America treats its, friends, how America treated its friends, and India was hit very hard with the 50% tariff, and for buying Russian oil, so politics, getting into the mix. Then IDR has been a domestic story of protests, so and now with the removal of Sri Mulyani as finance minister, so there's concern about fiscal worries. But Bank Indonesia has been active in intervening and in capping, So, and Vietnamese dong, which is interesting because he has been keeping to depreciation stance since for most of this year, So primarily, they haven't really been spared, and they've been watched very closely by the U.S. for transshipment of Chinese goods through Vietnam. Okay, I'm going to finish off before I pass away Liang. The official trading ban bifurcation. Okay, so this is just something that I've observed, is that in the past couple of months, we have seen dollar China, as I mentioned earlier, coming off from the top of its trading ban. So China has a trading ban for the spot rate, just like Singapore has a policy ban around the Sing-Near. Okay, so the Sing-Near has been coming off from the top ever since late June, and more so after the last policy decision to keep the three parameters unchanged. So what's quite interesting to us is that the combination has helped, has helped the China Sing cross rate to bottom, and he has sort of pushed up. So assuming that, let's say we are correct, okay, at this point, we are looking at, the Singapore slowdown story, maybe, ushering, out of consensus call for Singapore to maybe deliver a third easing, so in the slope of the Sing-Near policy band. Okay, so but we still need, to see GDP growth numbers come below the medium-term potential growth rates. We also need to see CPI and core inflation drop below this year's official forecast of 0.5 to 1.5%. So if all things follow through, then we'll be keeping a close eye to see if the CNY Sing rate can break higher later this year. Okay. With that, I'll pass it to Wei Liang.
Right, thank you, Philip. So for my section, I'll be covering the RMB and the yen, and what is the outlook in terms of the different policy settings, the different outlook in terms of policy divergence and bifurcation in currency performance for the RMB as well as the yen. So in terms of the RMB, it has become more less directed by policy in the most recent year. We have seen that huge volatility in the RMB previously has kind of eased off. So dollar RMB is now trading pretty much in a more narrow range, and it's in a range that's also very much driven by where and how the PBOC is setting its daily fixings. So you can see that over the last 12 months or so, dollar CNY fixings by and large has been quite stable around 710 to 720 level. Despite the fact that in the offshore RMB market, you could see dollar CNH actually having quite strong amount of movements, as well as the fact that there were constantly depreciation pressures, especially in the earlier part of this year. But because of the fact that its fixing has been relatively stable, and also at the same time, we are seeing an easing in the broad dollar trend. So the dollar CNH market has kind of settled off, volatility has eased off, and it's also gradually converging towards the fixing. But what's more, there's very clear policy preference on the part of Chinese policymakers to try to drive a gradual strengthening in the RMB. So why is that? If you take a look at the China's balance of payments, you could see, for instance, that the goods balance has been steadily expanding. That's largely indicative of a somewhat undervalued RMB that's supporting trade. And in this environment, when there's so much talk about whether trade is fair, there's a lot of scrutiny on whether are countries exploiting the international trading systems. I think to some extent it would be able to, for China, will be able to deflect a lot of this criticism if the RMB is on an appreciating path, to show that actually China is pretty much encouraging RMB appreciation, even though market forces might be leaning in the other direction. So that's one way by which trade tensions can be soothed to some extent by Chinese policy settings. And also, if you look at the fact that China is now involved in trade negotiations with the US, and there has been some news that the US, whether directly or indirectly, has been raising the issue of currencies with certain trading partners, including Korea. So currency as an issue has not completely gone off the table. So that might also be a secondary reason why we've seen PBOC actually allowing the dollar CNY fixing to gradually ease so as to nudge the RMB for appreciation. But does that mean that we could see very outsized strength in RMB? Again, I would say that's not really going to be the case. One of the reasons is because if you look at the growth conditions in China, for instance, PMI, they're still hovering below 50. So by and large, manufacturing sector is still in contractionary territory. So just today, we have the CPI and PPI numbers showing deflation dynamics taking hold in the economy. So our economists are still expecting rate cuts to come through in Q4. And in this environment, it's not too easy for the RMB to be strengthening, given that rate differentials will be acting in a different direction, with the PBOC still likely to ease monetary policy somewhat. So in terms of RMB strength, we're not looking for very outside strength, although the path towards gradual appreciation, that's pretty much in line with, I think, the policy direction. The second reason, if you look at the amount of southbound stock flows, so China and Hong Kong has a Stock Connect scheme by which mainland investors are able to invest in the Hong Kong stock markets. So this year-to-date, southbound stock market flows has soared to an all-time high of 170 billion. So that's a very significant amount. That's close to, I think, 40% of China's current account surplus in a year. So this suggests that that we could still see some degree of pressures given capital outflows away from mainland China into offshore markets. So why are these flows accelerating this year? So I think there are two reasons. One is that interest rates in the mainland, they're likely to be low for some time, so investors are looking for yield. The second reason is, of course, if you look at the state of AI, especially with DeepSeek having come to market, showing that it's a very strong player in AI. It means that China potentially could be catching up the US in terms of its AI capabilities. So there's a lot of investment opportunities that investors would like to tap on. So that's also one reason why we're seeing very strong inflows into the Hong Kong markets, as well as the fact that we are seeing a huge rally in Chinese stocks. So by and large, our view for RMB is steady, gradual appreciation. Moving on to yen, as Philip mentioned earlier, we are expecting policy divergence, right? So with the Fed poised to cut rates, and the BOJ still looking as though it's likely to be hiking rates, the interest rate differentials that drive dollar yen should be moving in a direction that favors gradual yen strength. So why have that not happened? A large part of it is due to idiosyncratic risks. We have news that PM Ishiba will be stepping aside and that the LDP will be holding leadership elections on 4th October. So why has that happened? It's happened in context of very weak showing in the upper house elections by the LDP, in which it's lost its majority. So that suggests that there's some angst in terms of cost of living issues, and a lot of opposition parties were suggesting that it's time to look at consumption tax cuts. So markets are worried that if a new leader emerges, he or she could distance themselves from the fiscally conservative stance of previous PM Ishiba. And this leadership election is also looking very exciting for two reasons. One, Japan could see its first female prime minister, Takaichi-san, who is actually in the lead. In the last leadership election, she came in second to Ishiba just last year. So she's going to put out a very strong showing. And also at the same time, we could also see the youngest prime minister in Japan's history, Koizumi-san. He was the second runner-up back in last year's leadership elections as well. And these two candidates actually presents two very different takes for the LDP party. Takaichi-san, she has favored expansionary fiscal and monetary policy. She is very much a supporter of Abenomics. But the problem is that we are now in a very different environment compared to the late 2000s, compared to the 2010s period when Japanese interest rates were very low, and also the Japanese yen was very strong. Now we've seen actually very acute outward pressures on Japanese bonds. Markets may or may not like the fact that Japan will embark on expansionary fiscal policy that could pressure JGB yields. So we've seen actually JGB yields inching up after this political uncertainty, inching up by about 6 basis. And that's really quite a remarkable development given that global bond yields, especially US 30-year yields, have come out 20 basis since the start of September. So there is some degree of concern on the fiscal front. Whether or not she has a say in BOJ's monetary policy, probably not, because the BOJ is still very much an independent central bank, but that's a policy stance that she has advocated in the past. For Koizumi, he is more of a moderate candidate. He's pretty much advocating for reforms. He was previously the agricultural minister and in charge of pushing some reforms in the agricultural systems to try to lower rice prices. So he is very popular. And then he has been quite actively engaged in social media. So definitely he will appeal to the renewal side of the party, where they're looking for a new leader, a generational leader who can bring about new policies to LDP. So if he becomes the next leader, then it's very likely we could see political risk kind of easing somewhat. So as I mentioned, if you look at the JGB yields, they have been rising. And it's not really unaligned with what's happening in the rest of the world. We are seeing globally steepening pressures in the US, in Europe, and Japan is not an outlier in that regard. But if you condition that global steepening pressures based on the historical relations, you still see JGB yields actually being too high versus where it should trade based on historical relations. So it suggests that the inflation premium in Japanese government bonds that's coming back. Either that or term premium is coming back, or there could be some concerns on the fiscal front. So that means Takaichi-san could create some kind of turbulence if her fiscal plans are not liked by the bond market. And remember back in during Liz Truss mini budget when the sell-off in gilts actually hit the US Treasury market. So it's not unlikely that if we see a big sell-off in JGBs, there could also be some spillovers into global bond markets. So that's one reason why this election is interesting. And the second reason is also if you look at the fact inflation, underlying inflation based on just the core measure, which excludes food and fuel prices, that has been quite sticky above 2%. That's not come off. We have seen US Treasury Secretary Besson stating that he thinks the BOJ is behind the curve, looking at how inflation is panning out. He may not be too wrong. So BOJ itself has said that there's a chance that it could embark a rate hike. So perhaps when political uncertainty fades out, we could still see a rate hike coming through in Q4. That's likely to be supportive of yen, but for now, dollar yen would likely still be somewhat sticky around the 145 to 150 level, given the political uncertainty. But over the medium term, towards the end of the year, we could really see dollar yen coming off if political risks dissipate and the fact that the interest rate differentials are set to narrow with the Fed cutting rates and also the BOJ likely to hike one more time by the end of the year. So we could see in the past, whenever dollar yen, whenever US-Japanese rate differentials widen, dollar yen tends to increase. And likewise, when this rate differentials come off, it's very likely we could see the same thing in reverse with dollar yen easing back. That relationship has not been particularly strong in the last 2 or 3 years, but it's still statistically very significant. So it's good bet for us to see for dollar yen to be easing towards the 142 level by the end of this year. And really, does Japan have to worry about rate hikes? If you look at how the corporate performance has been, if you look at for instance, the return on equity metric for Japanese listed companies, it has soared to record highs, supported by weak yen. So really, at this point in time, I don't think that there's going to be a lot of corporate complaints or resistance against a rate hike. Probably the BOJ will feel comfortable enough in communicating a more hawkish stance, and that's likely to be supportive of the yen going forward. So I'll just conclude with a review of our DEAR fair value metrics for G10 currencies and Asian currencies. So as mentioned, the RMB ranks as one of the most undervalued currencies in Asia. Right? It's about 17.2% undervalued. So that's also one reason why we're seeing PBOC being comfortable in allowing a modest amount of appreciation for the RMB despite continued economic headwinds. On the G10 side, the dollar still ranks as pretty overvalued, whereas the yen is quite undervalued, and I think that's pretty obvious why, because interest rate differentials have been pretty much acting against the yen. So that might change going forward. We could see valuations narrowing somewhat in the coming months with the US cutting rates, as well as the PBOC guiding for stronger RMB and the yen perhaps benefiting from a more hawkish BOJ. So with that, I'll pass back to you, Timer, for the Q&A.
Excellent, Wei-Young. Philip, why don't you also come to the stage? I have a couple of questions for you guys, just based on your presentation. Philip, very creative of you to take the word bifurcation and showing it band bifurcation and level bifurcation and so on. So very cool. Let's talk a little bit about Singapore. We've seen exceptional liquidity around it, strengthening of Sing dollar. Going forward, both SGD USD as well as overall NIR, where do you see things going?
Well, the NIR is coming off from the top, like what we expected after the policy review. So we took our guidance from the meeting that we are going to a slowdown, which is why I mentioned just now that we are watching the medium term, that GDP growth versus the medium term potential rate, and inflation against the forecast. So
but just one thing, Philip. Yes. So far this year, growth actually has surprised on the upside.
Correct. Yeah.
And inflation has surprised on the downside.
Correct. So, but I think the expectation is still that the tariffs, would feed through and would slow the global economy. But I got a sense that we are still resilient. Looking at the numbers, we may still see front loading because tariffs are not concluded yet. And I mean, we still have the Chinese trade deal. So, but I think the big question is really next year. So So far, I think most discussions been mostly about this year, but most of us are more interested in how the uncertainty is going to unfold next year. But meanwhile, I think given that the Fed is about to start cutting, and I look at the first two easing this year in January, in April, as a catch-up, to the 100 basis point cut that the Fed delivered in December last year. So I think maybe we'll be more aligned given given how low our inflation rate at this point is. Yeah.
What are your favorite tactical trades?
I wanted to, put on a euro, but I haven't had much luck with that because there's just too many things affecting that currency. So I thought, why not, choose some place less volatile. But of course, most people would disagree with me that UK, the pound is a place. But I look at the UK situation. It is not Liz Truss. It's not the mini budget crisis. I think at the end of the day, what she's trying to do is deliver, what she can for the economy within, the confines of the OBR. Whereas Liz Truss was just going ahead without the OBR, assumption. So
you're taking the Starmer government more seriously?
I wouldn't say I would. I'm putting my bet on him. I'm actually putting my bet on the Bank of England. Mm-hmm. That they were going to step back, let inflation stay high for a while, and maybe join the other European central banks in not, cutting rates because they have moved ahead of the Fed. So it's a laggard.
Right. So of course the euro has appreciated very sharply against the US dollar. I mean that's the most of the DXY move anyway. So you were basically saying that going forward, not that much oomph left for the euro, but more for the pound.
Okay. In the short term, because I've also showed at the beginning that after the first half of the year, dollar is moving down in the channel. Which is why at this point some people even think that maybe we don't have a big dollar story anymore.
Right.
But I think we still need to keep a close watch because Trump is pushing for trade imbalances. And
when I see your long-term chart, it can go to 80.
Yeah,
why not?
Correct. So, but right now I've just put it at 90 for next year.
That's a lot already. Yes.
Yes. So and even defending that, has been quite challenging.
Indeed.
Yeah.
Well, Young, when will the big JPY sell-off happen?
For the dollar yen to come off, we have to really wait for the politics to settle off. I think BOJ is also waiting for it. So it has indicated yesterday that there's still a chance of a rate hike. So
let me just correct myself. I didn't mean the sell-off, but when will the big JPY appreciation happen?
Yes.
Yeah.
So we are hoping that when the Fed cuts rates, it turns more dovish. We see a more significant slowdown in US growth momentum. Then that will lead to, I think, a lot of unwinds of carry trades because as we've seen in the past, when the US equity markets ease, then there's a chance that the yen could see a very reflexive rebound given the carry trades that has been so dependent on a cheap yen for funding. So fingers crossed, if we see slowing US growth, more aggressive Fed rate cuts, then we could see a more stronger rally in the yen.
Sure. Philip, final question. So in terms of bifurcation, the DMFX has appreciated against the US dollar. Some of the EMFX have not, particularly the IDR and the INR. I just got back from India, and there were a lot of questions there that why isn't the RBI just allowing the exchanges to slide? Why are they buying more reserves? They have over $500 billion in reserves. Why are they intervening? Why don't we just let it go to 90? Why are they so reluctant?
I think, firstly, I wouldn't rule out that US and India will go back to a negotiation table on trade. Secondly, they had a bout of INR weakness last year together with their stock market weakness. That's where you had capital outflows. So this round, I feel that it's not as bad as what we went through. And one thing about the dollar-India exchange rate is that it has this habit, of after a big move up, moving sideways. So I am actually looking at the 84, 88 range. It's slightly above So I'm still monitoring quite
84.
closely.
Our
Yeah.
clients would be
Yeah.
really, really interested to
Yes.
hear your view on
But
that.
you see, but the thing is that I keep telling them it's a range, but to them it's like a big appreciation.
Exactly.
Yeah.
Exactly. I think we'll have to wrap it up. We didn't really have any time for Q&A today, but I think there was lots to talk about on the FX side. So thanks to our listeners for your time, and we will come back to you in October. We're actually heading toward our annual Outlook season from October onwards. So as Philip just alluded to, that while we can discuss what the Fed will do in September, October, or what the MS would do, our real focus is really now on 2026. So starting from next live stream, we'll think more in the 1 year ahead term than anything else. And until then, thank you, Philip. Thank you, Wei Young. And thanks to our colleagues who made this happen. And until next time, everybody stay healthy, stay safe. Goodbye.